Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
We're watching, obviously, shares of Darden, but we're also watching shares of Amazon today higher, and they're on a tear this year. They're up about 25%. There's a few stories on what is one of the world's largest market cap companies, including wage hikes and a new AI assistant. So let's dig a little bit into Amazon. With us is Bloomberg Intelligence Senior Technology Analyst Anurag Rana. He's with us from our Chicago bureau. Anurag, I know the market overall is rallying, so I know that's probably one reason or a good part of why Amazon is higher, but we also see that it's, raising wages a little bit. Is this just something it usually does ahead of the holiday season?
I think it's probably driven by a lot of noise about unionization and a little bit of backslap, you could say issues around worker conditions. So I think it was long time due. It's good that they're doing it. One of the biggest stories for Amazon in the last 12 months to 2 years, which Poonam and I have talked about quite a bit, is Amazon's path towards improving profitability. So they have done that quite a bit. If you look at the stock over the last 12 months, it's done very well. And profit expansion is the biggest key of that particular thing. So now when the wages go up, that has an impact on margins. But at the same time, we also heard they are rationalizing their management structure. They're not going to be that many managers down the road. I think that's going to help offset some of these costs because more of the expensive workers are part of the AWS area and not so much on the retail side of it.
And the stock, it has done well. It's up over the last 5 years, 107%. Some of the other hyperscalers are doing much better. I noticed that Microsoft, for example, is up double that over the past 5 years. They just handed $60 billion back to shareholders or decided to start doing that for the second time. Is Amazon rewarding shareholders in the same way?
I think it's a focus for Amazon at this point far more is improving profitability, both on the retail side as well as the AWS side. We've seen AWS margins really spiked up quite a bit in the last 1 year or so. On top of that, their advertising business is doing very well, and that's a very high margin business. I think that is going to be probably the single biggest driver of next phase of big profit expansion for them, because that's very high margin. People, instead of going to Google to search for a product, may go to Amazon directly into the search engine to look for that product, and they can monetize on that.
What about the monetization of AI? Where are they on that? Because that was one of the other stories that popped up on the Bloomberg, launching an AI assistant designed to help some of their online merchants manage their own businesses. So what do we know about that? And I am curious if you could kind of put into context where Amazon is in the AI race.
Yeah, so when you look at AI and Amazon, I think the first thing you will think about is, their cloud business. That's where the bulk of the R&D and the bulk of the work is going to go, because companies will use their cloud services and third-party models to come up with their own solutions. So that's more on the, selling of cloud resources or technology side of it. As far as they using it themselves to be more productive, content creation is an area, and that's where the application that was launched today would help their merchants to be online very quicker, much better description of the product, pictures, and what that does is it helps out to get to your products to market quicker in a far more effective way than you and I would do. Let's say if we are a third-party merchant, this just helps it in the everything from point zero all the way down to the selling of that particular product.
What? Why are you looking at me?
Well,
you're freaking me out here.
So you don't know about my obsession with the comp function, or maybe you don't remember, but Paul Sweeney knows.
I like comp.
I use it all the time.
Yeah.
And so I'm just putting up Amazon against the other FANG peers, right? Or the other mega cap, what do we call Magnificent Seven stocks. So Amazon has doubled over the past 5 years, up 108%. Facebook is up 195%, right? Apple is up 313%. Netflix is up 146%. Google is up 162%. Microsoft, up 211%. All of them. And I won't even mention NVIDIA, because obviously they destroy this group. But Amazon's the big loser among the Mag 7. Why is that, Anurag?
So why don't we try the last 12 months? I mean, they've done better than Microsoft.
I always do
really
5 years. It's just my basic.
Yeah.
Because it's the default of the comp function, I've done it since I started working here in 1999.
Yeah, so one of the things I'd say is, we are building in a lot of the up that happened during the pandemic and the down in that particular one. If you run a 10-year number on comp, which I just did while we are talking, Amazon's annual growth rate is 24.6% and Microsoft is 28. So not that big of a difference between the two. But, Amazon's been a very good story for a while. And frankly speaking, if you look at their cloud business, just that alone is far more profitable than most people understand Amazon to be. It's the retail side of it which is dragging it down. But frankly speaking, if you look at it for the next 5-7 years, I think they have a long way to go.
He's not wrong. Over the last 10 years, Amazon's the best performer in the group.
Yes.
This is why we talk to Anurag, right?
Yeah.
Longer term.
I can't believe the retail business is the drag. Like, I buy stuff on Amazon every day. Is it because people are mad that they seem to have, more Chinese retailer than any other nationality?
Well, isn't it expensive also to get all this stuff out?
Yeah, see, Matt, you're at this point comparing a technology business with a retail business. So you got to take that, with that particular aspect of it. Those are single-digit margin businesses, frankly, in the long run now. You're comparing it with a gross margin business of 75-80%, which is the tech business of it. But when you look at logistics of Amazon, it's going to be very difficult to come up with anything even close to that over the next 5 years. They doubled their logistics footprint during the pandemic, which is not good for the shareholders in the short run. But I would contend that in the next 5-7 years, it'll start to pay far more dividends than it has done so far.
Well, all right. So I don't know. We're not into earnings yet. I do wonder, how you're thinking about the environment. It seems like the Fed kind of giving a juice to certainly these mega cap tech names today. Certainly, you see it in the trade. But I don't know. How does the next 6 to 12 months look specifically for Amazon?
I think, one of the good things in this particular case is going to be small businesses. This is, I think, the one thing I haven't heard a lot of people talk about it today or since yesterday. They have been struggling because of high cost of funding. It's not the big guys. I mean, Amazon and Microsoft and Apple, they don't really care about what cost of funding is. They have too much cash on their hands. But when I look at companies, smaller software companies that cater to the SMB market, they're really struggling. And I'm hoping with this particular pivot, the consumption of cloud goes up from the SMB community, which will help Amazon. The SMBs that are selling their products on Amazon's retail framework, that's going to go up. So I think net, it is going to be good for Amazon's end customers as well as its suppliers.
I talked to Steve Eisman on my television show this morning. He of Big Short fame from Neuberger Berman, and he doesn't do shorts anymore. He just has a portfolio of 30 to 35 longs, and he invests in two stories. One's infrastructure, the other is AI. And he was saying that medium to even large size businesses, they don't even have their data sorted out to use for Gen AI yet. So they need to partner with these other AI, masters of the universe in order to get that done. And I wonder, are people going to reach out to AWS before they reach out to, Microsoft or Google? I mean, is their AI business going to be a big moneymaker for them?
Yeah, I mean, AWS is the biggest cloud vendor out there just in terms of market size. So that's going to do very well. As far as data is concerned, each one of these companies has their own data framework. I did listen to Steve this morning, and he talked about Accenture's, business of cleaning that up. Frankly speaking, there was a mix-up. I mean, he talked about the outsourcing business, but that's completely different. It's the consulting business where the data cleanup happens. And from that point, they are still in that phase of a slowdown. But having said that, we think that the data cleanup issue is a very long-term secular cycle for all technology companies, not just, either Accenture or AWS.
Did we do a good job? Did you like the interview, Anurag?
Oh, it was excellent. Excellent.
Thank you.
You put him on the spot. You think he's going to say no?
You can catch my television program, Bloomberg Open Interest, every day from 9 to 11.
Nice guy. Hey, one more thing before you go. There was a story headlines about Intel. This was, I think, earlier in the week, at the start of the week, about Intel making an AI fabric chip for Amazon Web Services, and the two are looking to
got a customer.
Potential for further designs. It was great news for Intel. What do we need to know about this?
Yeah, so think about it this way, and I'll take you back to Apple. Apple, a long time ago, was buying Intel chips. It was getting heated up. They weren't able to do some stuff with it. So then Apple decided to design their own chips, which they do, and then TSMC makes it for them. Made a huge difference to their Mac portfolio. All these cloud providers, whether it's Amazon, whether it's Google, whether it's Microsoft, they are all going down the route of creating their own chips, designing their own chips. When I say creating, we mean you just design it and somebody else creates it for you. So Intel is probably, one of the people they're talking to. I bet you they're talking to multiple other people to help out with that thing, because the number one problem for cloud providers right now is the lack of GPUs and chips that they need to take care of the AI workload and the other workloads.
Wait, if everybody designs their own chips, what do we need NVIDIA for? They don't make chips. They send their designs to TSMC too.
Yes,
Stay
exactly
tuned,
my
right?
point, but that's going to take some time.
So they have a little bit of a runway, probably a fairly good sized
They're
runway.
doing
but
a pretty good job.
They're doing okay.
Exactly.
They're doing okay. Anurag, thank you so much. Anurag Rana, of course, joining us right there. Bloomberg Intelligence Senior Technology Analyst out there in our Chicago bureau. Iceman,
Yeah, he's
that-
always a lot of fun to talk to.
what was the most interesting
You know what's cool
takeaway?
about Steve Eisman?
What?
He won't give us pre-interview notes.
I love that.
He doesn't. He's like, listen, I'll show up. You ask me what you want to ask me.
Surprise!
And if it's interesting, it'll be a good interview. Yeah, he said last time he was on, he said Trump has 100% chance of winning.
And now?
But since then, Joe Biden dropped out of the race, and now he says it's a coin toss.
All right. Well, that's interesting.
Yeah.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
S&P 500, we've been talking about it, did hitting an intraday, right, all-time high. We'll see whether or not we close that way. But it could, if it does close at a record, it would be its 39th record this year, Matt.
And you know what's crazy? Yesterday,
crazy?
after the Fed decision, the market had 2 hours to be open and figure this out, and we closed down.
Yeah.
Then all of a sudden this morning, I'm looking at futures up 2% and
Everybody's
thinking,
like, wait, yeah, it's good.
Overnight, did somebody tell Mr. Market, actually, the dot plot is way underestimating what they're going to cut? Or did initial jobless claims say, hey, look, he nailed it. It's a soft landing.
Right. And things aren't falling apart.
Yeah.
Right. And that's what you want to see. Jeff Crumpelman, we'll see what he has to say. He's Chief Investment Strategist, Head of Equities over at Mariner Wealth Advisors. They're based in Cincinnati. He's joining us back in our studio. How are you?
I should have known you were from the great state of Ohio. Now it
from
all makes
Ohio.
sense. Yes,
I've lost
go
them. I've lost them
Buckeyes.
for the next 10 minutes. You, though, expected a quarter-point cut.
I did.
I expected a quarter-point cut.
I also, until yesterday,
When?
Until I think on Monday morning, I talked to Ed Hyman and he convinced me.
Oh, okay. Pretty
But
good.
but I have been expecting, because they didn't really telegraph a 50 basis point
Well, there's
cut.
a little
I
bit
thought
now.
this Fed wants to tell us what they're going to do, but
Do you think the Fed got it wrong or right then?
What's that?
Do you think the Fed got it wrong or right then?
You could justify either one. It was kind of a flip of the coin with a slight edge that I gave to 25. And I think that the 25 would have said we respect the inflation number that didn't improve as much as we wanted it to in the prior month.
Right.
And, the fact that economic growth is not all that bad. We've got a number of things, unemployment claims and retail sales and all this stuff that just came out that says we're doing okay. The Atlanta Fed is saying real GDP growth at 3% pace. So I thought, Powell probably would push for 50, but the committee, given if you look at some of the members, just a little more cautious and conservative, I thought he wouldn't convince them. And by going 50, okay, fine. What they've done is said we're going to be proactive in case it is slowing
Is
down
it
a little
really
bit
just
more.
fine, or is Matt, like you kind of were peppering Mike McKee? Is there something the Fed sees, or Jay Powell, that we need to be worried about?
I just don't understand. 5.5% didn't feel particularly restrictive to me, considering how well the stock market is doing, how well unemployment is doing. I know we went from 3.4 to 4.2, but still 4.2 is well below the long-term average.
I could take your case, but I'm going to, since you're asking
Thank
me
you.
to take the other case, the other case would be we are way away from normal real Fed funds rates. And we're at 5.5%. The normal real after inflation Fed funds rate is about 1%. So that means that you would have to get, if inflation's at 2.5%, you got to get Fed funds down to 3.5% to get back to normal. So, you have Jeffrey Gundlach out there saying they should have gone 25 in the prior month. So fine, kind of the way I resolve it in my mind is, well, if they would have done that and started their measured kind of approach, it would have been 25 last month, 25 this month, a total of 50. I think what freaks people out is this, all of a sudden, these guys are saying, we fought inflation, we're comfortable, now we're really going to focus on employment. And they were willing earlier to let inflation run to 2.5% or 3% hotter before all this stuff started a couple years ago.
Yeah.
And now I think they're going to err on the side of being, if they're going to be wrong, they'll be a little too aggressive in making sure that.
And Powell said as much yesterday. I mean, he said, "Could we have cut at the last meeting? Yeah, we could have. Mm-hmm. Yeah, and we would have had we seen the employment number that came out right after.
Right.
Yeah.
But it doesn't make that much of a difference. I mean, 1 month. Even if you think the long and variable lags are shorter now, they're not that short.
Yeah, and at the end of the day, we look at three things when we look at the markets. We look at fundamentals, valuation levels, and technicals. And from a fundamental standpoint, you look at the economy and trends in the economy that are solid. You look at overall interest rate trends that are stable and coming down a little bit, and you look at credit spreads. All that stuff is good, and earnings are very good. So if inflation's falling, margins are expanding, you got good business models, that tends to be a decent time in the market.
All right, well, let's talk a little bit about some of the names that you like, because the semiconductor area is definitely outperforming. It's up, I'm looking at the stocks up about 5% so far in today's trade. If I look at some of the best performers in both the NASDAQ 100 and the S&P 500, AMD is on that list.
Yeah.
You like AMD. Why that name in the semi space?
Well, I think that it's just a diversified way. If you've had your fill of NVIDIA, and you've had so much success you can't stand it anymore, why don't you diversify a little bit and get some AMD in there, which also benefits from the graphics chips and the expansion in cloud and data center, but also has some cyclical stuff going on with just CPUs that they also manufacture. And you got a 30% growth rate trading at about 35 times, which is a wonderful peg rate. Mm-hmm. You don't just have to own one semiconductor company. You can spread out the risk a little bit. Would you still own NVIDIA? Absolutely. We under-own it relative to its weighting in the market. Those things are crazy in terms of their percent of market value of the indices. So I think it's something like 11% of the Russell 1000 Growth Index. We own more like 7% of it in our portfolio. So yes, and it is, in terms of earnings growth, we're looking for 80% earnings growth, and it's trading at about 30 times. I'm sorry, but there's not a whole lot not to like about that right now.
Just at the numbers.
Yeah. Did I tell you I talked to Steve Eisman this morning? He was saying pretty much exactly the same thing you are in terms of the economy and the Fed, and he also likes the AI story.
Smart guy. He must be a real.
he says there's got to be a story. He said we're in good times right now, and in good times you got to have a story to invest in.
Yeah.
I see that you like Eli Lilly. I love this story.
Yeah.
What do you think about the wonder drugs? I mean, I get a little bit too optimistic about these things. I also loved, mRNA. But what do you think about?
Well, every
GLP-1s.
Every couple of months, we go off-site and we sit down and although we do this daily, we look at what we call the FVTs, fundamentals, valuation level, and technicals, and we rate each stock. And going in, I thought, come on, Eli Lilly's run, and I've got to nick it on valuation. Not really. 40% growth, 40 times, kind of PE, and in terms of these, wonder drugs, it's driving that growth. Now, to counteract that, another idea I gave you guys was ResMed, which is a sleep apnea company.
And a sleepy stock as well. I mean, Eli Lilly over the past 5 years is up 700%. ResMed is up 81%.
81's not bad, and I think also that's the opportunity. And everyone's saying, well, these GLP-1s, now all of a sudden
you might not need it for that. It helps out sleep apnea.
Yeah, we're going to sleep now. I guess everyone's going to lose 40% of their body weight, and you're going to sleep just fine. And that's probably not the case. So you counterbalance that a little bit. But
if they would only give it to me, if they would just give it to me.
Which one?
Ozempic or Wegovy, or I don't care what. Just to get
Do you need it?
I need to shed some pounds. My wife's angry that I'm snoring. I'm always turning the AC low, It would fix some. Plus, I'm going to get Alzheimer's, probably heart disease. Like, I want to avoid all those things.
Well, you don't want to OD on those. You get
I'll just take a little bit.
I forgot what it's like to work with you. Always fun to see you. Jeff, thank you so much. Jeff Crumpleman, he's Chief Investment Strategist, Head of Equities over at Mariner Wealth Advisors. Someone from Ohio, Matt.
We're all good people. Good people from Ohio.
You are.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Mortgage rates continuing their decline, hitting the lowest level since early February 2023. Borrowing costs have fallen significantly in recent weeks in anticipation of those rate cuts by the Fed. We got that first cut yesterday. What's interesting is whether or not, Matt, people are going to maybe hold off on buying a house thinking, okay, rates are going to go even lower.
Yeah, I think it's really fascinating to watch home prices right now. Obviously, with lower rates, you have an in, but especially in this area, there's a state and local tax deduction cap.
Stop! Don't go there
right now, which makes it it makes it a lot more expensive to own a home in this area. Now, if certain things fall into place, that could sunset next year, and then you could see a flood of buyers.
We shall see what
in Westchester.
Well, let's see what our next guest has to say. Thomas Carroll's back with us. He's the founder and CEO of Ballast Rock Asset Management. They've got about $240 million in assets under management. He's also a former Goldman Sachs head of trading for fixed income currencies and commodities. Back with us. How are you?
I'm excellent, thank you. Busy day in the market, but fascinating day in real estate for sure.
Why? Because of the Fed move?
Actually, I think the Fed move was largely priced in, but
all 50 basis points?
Depending on the house, different house views, different places, but on average, more or less, that's what you've seen in rates.
The market priced it in like 70% chance of a 50 basis point cut. So.
And more or less, you've seen that in rates movement, but more importantly, what you've seen today with secondary home trading, for those of us that are on the institutional investment side, looking forward at deliveries, in particular in multifamily, which is our area of focus.
Right.
But deliveries in 2024, projected deliveries in 2025 and 2026, really dropping off a cliff. So with 24 deliveries expected to be around 611,000 units this year, but next year a 45% decline in deliveries, and again a further 15% in 2026 projected. What we see is the potential for substantial rent increases in the next 2 years, in particular in 2026. And the question, therefore, is what does that mean? How quickly can those of us with capital to deploy, how quickly can we get long the market, and can we get long enough in a more accommodative rate environment?
Wait, can people afford to pay more rent? I mean, the rent's already too damn high, right? So is it just which areas can see a rental increase?
Well, you guys play in the South in a big way.
We do. We're exclusively in the Southeast, in the Carolinas, in Georgia, in Tennessee, Alabama, Northern Florida. But interestingly enough, the data shows that the differential between the cost of owning a home and the cost of renting a home has increased over the past 12 months by a bit more than 20%. So it is still about 40% cheaper to rent on average nationally. Obviously, it depends exactly where in the country you are, and different markets have different demand and supply dynamics. But in general, nationally, it is still cheaper to rent. So therefore, for those landlords that are looking at a drop-off in new supply in the years to come, we're certainly eyeing an expectation of increasing rents.
What's it look like in your areas, in your region?
Well, I can just say for our portfolio, for example, right now of our existing assets, we are currently running at the highest revenue levels we've ever run at. Meanwhile, actually, occupancy is not actually at peak. So that means that rents are at the highest that they've been. And our forward is we're not offering concessions. We're running very close to peak occupancy. That means that there's further pressure upwards on rents.
Thomas, I've got to ask you, though, in an election year, and we talk so much about the affordability or lack thereof of individuals being able to buy a home or even afford rent. I do wonder whether you think about, whether the spotlight or that investors owning real estate, their role in pushing up the cost of housing, which is something that has certainly played into inflation in a big way and sticky. how are you thinking about that? And, where politicians may come in and say, listen, we got to do something about this. Because as you say, the lack of supply in the next year, it's not going to be there. So it's just going to get tougher for individuals. How, and there's a point where, different investor bases, all of a sudden politicians are, looking at you saying, well, wait a minute, this is maybe not fair.
Absolutely. And so for us, we focus really on the positive social impact that we're able to have through our funds, through our investments, because we are making very substantial investments in these assets. We focus on taking older properties, Class B, Class C assets, and upgrading them, improving the quality of them. So yes, rents do go up, but they don't go up in a vacuum. They go up because we're investing millions and millions of dollars in our assets to make them higher quality assets. So from our perspective, we're changing the nature of the asset itself from something that may be less safe. We focus on safety, security for our residents, a better quality experience, etc. In those circumstances where we're genuinely adding value, changing the nature of the asset, changing the position of the asset in the marketplace, and in particular, given that we focus primarily in states that are a little bit less governmentally driven, let's just say, they're more landlord.
The other way.
They're more landlord friendly.
Fair.
Let's put it that way. They're more landlord friendly. We don't view that as a massive risk for our portfolio, but nationally, certainly, we see the discussion and.
But what's your role in all of this? I always.
Or what
think
kind of
about
pushback
that.
do you think the industry is going to get? Because the anger, especially coming from the Democratic side of the aisle, but really from all populists, and the Republicans have now become a real populist party, has been directed at funds that are buying up supply. So not necessarily your fund,
right?
No,
right?
I understand.
But, yeah.
So there certainly needs to be substantial new development. That's the critical piece that's missing.
Right.
Our role, for example, in our current funds is improving antiquated assets that otherwise would just get worse and worse and fall into disrepair and actually be unusable. So we're taking 1970s, 1980s assets, 1990s assets and making them very usable. But really the way to resolve the affordability crisis is through new development. That's it.
And what needs to happen? What kind of incentives need to be in place? I think Kamala Harris has spoken about, incentivizing new
Giving kind of like a credit.
new building.
Yeah.
What needs to be there? Are we talking about tax cuts? Are we talking about regulatory cuts? Donald Trump has talked a lot about cutting regulations in order to spur new development. What, in your view, needs to happen so that builders can come back in and really start? I mean, I feel like they've been afraid since 2008.
Certainly. In fact, if you look at the average delivery of single-family homes in the 10 years after the global financial crisis versus the 10 years prior, the total delivery was 50% less on average. So certainly they've been very nervous since 2008 and haven't delivered. But there is a little bit of dealing with the not in my backyard component. There is, remember, a lot of these regulations aren't necessarily federal. They're local and zoning.
Land acquisition and zoning. Yeah.
So that's actually arguably where the bigger challenge is.
But where we started is, you said one of the positives to what you guys do is the lack of supply, right? That's good for what you're doing,
That's
right?
good for our business.
It's just basic supply and demand in terms of, kicking up the prices of what you can charge. So having said that, you've got to watch it, right? Because you don't necessarily want a ton of building to come into some of the markets that you play in, right? Because that will impact potentially those investments.
Theoretically, but in practice, it's sort of apples and oranges. New development, on average, say, reasonably cheap cost of development in the US per unit is about $220,000 a unit. We're acquiring assets often below $100,000 a unit. So a new apartment, multifamily apartment being delivered for rent needs to rent for, let's say, $2,500 a month. Mm-hmm. Our average rent across our portfolio is $1,000 a month.
Is it really?
So it is totally different. To step up from a Class B or Class C older renovated unit into a Class A newly delivered unit is almost 2.5 times. So think about that. You get a slightly better job, you get a pay increase. Doesn't mean that you're getting a 2.5 times increase. They're fundamentally different markets.
Right.
So all these new deliveries really all the deliveries that are happening this year, next year, and the year after, they're almost entirely what are called 4-star and 5-star deliveries. So they are really
it's new build.
They're
it's
new
different.
build. They're luxury. So actually, the real challenge is how do we develop more workforce housing? How do we either renovate the existing assets that are there, improve them, make them safe, secure, clean, professionally managed? How do we do that? Well, that's where my fund and our teams step in. But then how do we deliver more affordable housing, not just luxury homes,
right,
on luxury apartments?
How helpful is then this first 50 basis point cut, and how much do they have to cut before it's no longer restrictive for your industry?
So we, for example, because of course the changes in Fed funds are already effectively priced into the longer end of the curve, and that's ultimately how our debt is priced. We aren't borrowing on a floating rate basis, we're borrowing 5, 7, 10, 12-year fixed. So I don't particularly care what happens to Fed funds, I just care what Fed funds implies for long-term yields, and thus what happens to the long end of the curve, or the medium end of the curve, where we're pricing our debt against. For us today, we're actually borrowing pretty equivalently to where we were borrowing 5-6 years ago, because spreads have compressed. So when we borrow money, Fannie and Freddie spreads are almost at all-time tights. Those debt capital markets are wide open. So a combination of kind of a 350 10-year and our spread cost of borrowing means that we're borrowing in the mid fives, which is quite possible, attractive for us. We're buying assets on an unlevered basis at about 6.5%. So with leverage, we're able to create attractive total returns for our clients and our investors.
Great deep dive.
Cool.
Thank you. Great to have you back. Thomas Carroll, CEO at Ballast Rock Asset Management.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It drives me crazy.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just under 20 minutes left in today's trading session, and we've definitely got a rally underway. We're off our best levels of the session. Charlie, of course, just breaking down the numbers, but still, Matt, 2.8% higher on the NASDAQ 100, almost a 2% gain on the S&P. Wow. I know. It's okay. So Fed cut.
So
Have a point.
and helpful to the big mega tech.
Yeah.
Mega cap tech companies, right? Because NASDAQ 100 is such a big gainer and the S&P is only up 1.8%.
SOX is up 5% right now.
The Philadelphia Semiconductor Index?
Yeah.
Amazing.
Yeah.
I mean, it just continues to climb higher and higher, and I guess it just took the market a while to understand what happened yesterday.
Yeah, I'm just looking at small caps too. They're up 2% here as well. So you're seeing really broad-based buying. All right, so let's see what Greg Halter has to say. He's Director of Research at Carnegie Investment Council. They've got $4 billion in assets under management, and he's joining us from Cleveland, Ohio. Another Ohio guy.
Wow, the great state of Ohio.
How did we do this? Is Greg there?
I am here.
Hi, how are
Go
you?
Buckeyes.
OH.
IO.
How are you?
Good. Thank you for having me back.
Well, it's good to have you back. Always appreciate what you have to say about the market environment. It is true. Interesting. Yesterday we saw a rally and then we saw a pullback on the equity side of things, but it does seem like investors are all in on stocks today. How has the Fed move yesterday and commentary in any way influenced your thoughts when it comes to strategy in the equity markets right now?
Well, for one thing, we are pleased that the market is up, but I'm not sure it's changed our thoughts. Again, we look for market leaders. We look for companies over the long term that have some sort of sustainable competitive advantage. And there's plenty of them working out today in the stock market. But I'm not really sure that our strategy has changed at all because of 50 basis points.
So, yeah, I mean, I guess this was priced in, and you could see that rates, the Treasury market had already kind of priced it in as well. What do you expect the Fed to do going forward? And I don't mean to say like what's next already, since we're still dealing with what happened now, but where's your terminal rate expectation, and how important is that?
Well, I don't know that we have a number to provide for you. I would just say that we do expect for yields to be lower, certainly in the over the next 12 months. Obviously, if you look at the dot plot, what is out there right now, it does indicate that rates are set to go lower from all spectrums
to 2.9%
down to 30 years.
Yeah. So, I mean, I wonder if the Fed is being a little bit too conservative here. We've heard from, John Paulson said he thinks 2.5%, right? Whereas Howard Marks says 3%. I guess it's not that important.
Mm-hmm. Yeah, I don't know that, are we dealing in basis points? I think the direction is more important, and lower rates are certainly going to help anyone that's on a variable rate, from the consumer to the commercial side of lending, anyone who has loans. On the other hand, we've got 6.3 trillion in money market fund assets, and those are going to be yielding less. So there's less income in the savers' pockets as well. So again, I think you have to look at both sides.
Can we assume all of that money? I feel like there's been, folks salivating over where that money's going to go, assuming it's going to come out of money markets. Although I thought I heard a few months ago somebody saying historically, money market levels kind of stay around this. This is just what we see. But help me out here. And is that momentum certainly for other asset classes eventually?
I really don't think so. I think history is on the side of what you had mentioned. That money tends to stay there. It tends to be very sticky. And if someone's getting 4.5 or 4.75 relative to the risk they perceive in the market and the volatility, a couple of weeks ago we had a huge drop, and some people got nervous. So 4.5, 4.75 as rates come down, that's not all that bad. If we get back to 3 or 2, where's the tipping point? And you may see some of that go into the market. And, we've had an increase of a couple trillion, I think, over the last 4 years in terms of money market funds. By the way, there's 3 trillion sitting in checking accounts, demand deposits, earning nothing right now. So there's an opportunity for people to earn money. They should be taking advantage of that. And for whatever reason, they're not. It's baffling.
Well, if somebody has money that she or he needs to put to work, where do you expect that to do best? I know that in your notes you point out that banks and biotech have tended to do well the 6 months after a first cut. Is that where you would go?
Yeah, I think that's a good place. Again, you're talking sectors. I would prefer to invest in some of the best companies that we can find. And there's not that many of them out there when you think about the compounders of the world, the Echo Labs and Sherwin-Williams and Eaton's and companies like that. There's just not thousands of them. You've got to look for these solid companies, good balance sheets, good cash flow, companies that have been around for a while, and they're benefiting from secular positive trends in their industries.
Such as?
I mentioned a couple. Another one would be TradeWeb, which is on the whole fixed income and money market side of electrifying or electrification, if you will, if that's what you want to call it, electronics of trading. That's a company that we like. Cintas is a fabulous company. Otis, which makes elevators, is an excellent company. I mentioned Sherwin-Williams and Echo Labs. Obviously, you've got Microsoft and Apple and NVIDIA as the Mag 7 names, but there's plenty of other companies within this 100 or so that we like to invest in and talk about that are out there.
You mentioned Sherwin-Williams. It makes me think of the housing market.
Yeah.
What do you expect the fallout to be in the housing market? A lot of people have implied that when rates go to a 5-handle, mortgage rates that is, that the market could start to move around a lot, but I mean, I have a 3% mortgage. It's going to take a lot more than that. No.
Yeah, mine's at 2.65, so I'm
Congrats.
not keen to give that up and go anywhere soon. And on top of that, you've had a huge increase in home prices, so you've got that double whammy. However, there are people, and I just spoke to one today, they have 6.37% mortgage. They can start refinancing, and the people who are on the fence can start coming into the market. Yesterday, we saw, a 9.6% increase month over month in housing starts. So, some of this stuff can percolate, and that goes to the Home Depots, the Lowe's, the Sherwin-Williams of the world.
Greg, do you think by any chance that traders, investors are getting kind of ahead of themselves in terms of expectations, despite what the dot plot says from the Fed, that maybe we won't get all those moves either later this year or into 2025?
Oh, tough question. Very tough question, Carol. I mean, obviously the data is going to be important. What happens with inflation? And we've had the two sticky items, insurance and shelter. Where do those go? Everything else seems to be fairly tame at this point. But with these rate decreases, what does that do? We're going to have to let the data really tell us where that goes, because, you know as well as I do, we're in a $26 trillion economy. Things can move around a lot, and the stock prices can move a lot differently than the actual fundamentals of the industry or the company.
Greg, does the election matter to you when you are planning out for the future?
And just got about 10 seconds.
Not really. It's more media attention. History shows that it really doesn't matter in terms of the markets over the long term.
All right. Going to leave it on that note. Hey, Greg, fun to get some time with you again. Greg Halter, Director of Research at Carnegie Investment Counsel, $4 billion in assets under management.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.